All right, welcome everybody. Well, I know a lot of you have been anxiously waiting for this video. Over the last several weeks, we have been talking about going with our live morning show, but part of that is we've made some changes. We're actually expanding not only what we trade, but also how we're doing some of our trading. All right, and there's been a lot of excitement around it, because everybody seems to be doing well and making a lot of money. And so I wanted to go into just a little bit more about kind of what I'm doing. I won't be able to get into the exact details, but I'll give you a basic understanding of how I'm trading, what I'm looking at, and then, of course, all the different instruments that we can use this in. Okay? So the name of this short tutorial is going to be predicting price levels with the Einstein Formula using Nadex knockouts. You don't have to use Nadex knockouts, but I think there's a huge advantage for using Nadex knockouts, and we'll be getting into that as well. But the question is, what the heck is this Einstein Formula? You may or may not have heard me talk about it before. So let's talk about that a little bit. All right. So as you know, I've been in the business for quite a while. Started back in the early 80s, and it was really late 1989 that I found out about this. And so basically the Einstein Formula, the name Einstein Formula is basically a mathematical formula conceived by a very successful private day trader back in the 1980s. And what he was able to come up with, now he's doing a lot of scalping, a lot of short-term trading, definitely a day trader, mainly in the S&P 500 and T-bonds. But he came up with this formula that calculates the prior wave size, and you can go X number of bars back. X number of bars back will determine the size of the move. All right. He looks at the prior sizes, okay, of those bars, and he looks at the tick volume to predict the direction and price levels for the next upcoming wave. Each level has its own probability of hitting, starting at a hit rate of 75% and then going down from there. So if you notice what I've been doing in the room here lately is I've just been calling that first level, because that first level has your highest probability. All right. And so I don't really think you need to go beyond the first level. Now, if the market is really strong, you can carry it further. That's up to you. But for me, in order to manage money properly, I think if you just go to that first level, you're going to be fine. All right. The formula can be used with anything from stocks, futures, forex, or cryptos, which is all of those we're going to be tracking. All right. So in this presentation, I will be trading Nadex knockouts instead of the underlying instruments to place my trades because of their advantages. And those that are familiar with knockouts know what those advantages are. But let's talk a little bit about what are knockouts, because a lot of people are just not familiar with knockouts, right? So what are Nadex knockouts and how do they work? A lot of this I basically just cut and pasted from Nadex, because they do a really good explanation of Nadex knockouts. I added a few things in here to help clarify it a little bit. But basically, knockout contracts are financial instruments that are exclusive to Nadex. They are designed to offer traders more opportunities in the markets with risk management built in. You will have clear profit targets on your trades, so you can plan your strategy and pick knockout contracts that work for you. Get all the excitement in moving markets with defined outcomes that protect you during trading. If you're new to trading, these contracts are structured to provide a simple entry point to the most popular markets and this is the key, with a built-in exit strategy for each trade. If you're an experienced stock, futures, or forex trader, you have the added benefit of trading markets you're already familiar with using the same trading analysis technique. So, you can trade knockouts using anything, all right? But the beauty of the knockouts, as you will see, is it's a huge advantage over if you want to just go out and trade an outright futures, or if you want to trade one of the stock indices, okay? And definitely I think there's advantages over trading individual stocks, because we're trading the overall market, which is a lot easier to predict than an individual stock, all right? So what is a knockout? A knockout is a financial instrument that has built-in profit targets. All right, so it has built-in profit targets, and it also has a built-in maximum loss as well. The contract has a floor and a ceiling to protect against big losses or to lock in profits. As soon as one of these is hit by price, the knockout contract expires. So the beauty of this is we still have the flexibility that gives us plenty of room with these knockouts to trade that action, okay? But in the case of something catastrophic and you're in a trade and something catastrophic comes out and it moves adversely against you, right? You don't have to worry about being on a margin call and coming up with more money, losing more than you expected. It will automatically get you out. And you will know that, and I'll show you that. You'll know that before you even get into the trade, what your maximum exposure is, all right? And then, of course, it's up to you whether you want to take that maximum exposure or not. You choose to buy or sell a contract depending on which way you think the market will go. All knockout trades are limited risk, which I just mentioned, and you will know the maximum possible loss or profit up front, giving you a built-in plan for every trade right from the start. So if we have a particular call, let's say we're saying that the market's going to go down, and let's say you have X number of dollars risk, and you decide, well, you know what? Even though I have a 70% probability, I don't want to take on that kind of risk. Well, then what you can do is before it hits target, if that risk narrows, and it can narrow, and I'll show you how that works, then you can go ahead and wait with the idea maybe we'll get a little pullback before it actually hits the target, and you can do that. All right, I have tried that. It works quite well. A lot of times, though, what you're going to find, particularly in the morning, is that's not going to be the case. Typically, when it hits my entry point, it's on its way to that target pretty quickly. All right, so that's the thing. So it's kind of a give and take. All right, you may miss some really nice trades, but at the same time, you're going to catch some trades. You won't have a whole lot of risk, and that whole lot of risk really is depending on what is a whole lot of risk for me or a whole lot of risk for you. May be different, and of course, also depends on the size of your account. Right, larger account sizes obviously have some advantages over smaller account sizes. As you know, if you've been a trader. But so that is going to be something you can determine before you even get into a particular trade. Okay, so how do knockouts work? Well, the two main things that set knockouts apart from other types of financial instruments are the floor and the ceiling, which create a trading opportunity that includes a built-in exit strategy for both profit and losses. Here's an overview of how they work. So you have two of them. You have a floor and a ceiling. So the floor, if you're buying the contract, this is the level that prevents you from incurring major losses. So the floor is going to be below wherever you buy it at, right? If selling the contract or going short, then this level is going to be your maximum profit potential, right? So basically, it's like a 0 and a 100, all right, as an example. So if you buy it at 50, and it goes down to the floor, then you lose 50. If you buy it at 50 and it goes to the ceiling, you make 50. Okay, that's just to simplify it. All right. Obviously, there's a lot more in between than that, but that kind of gives you a basic idea of how that works. And likewise, the ceiling, when buying the contract, this is the take profit that prevents you holding on to a trade for too long and risking the trend reversing. So if you're buying it and it hits the ceiling, it's going to get you out for that maximum amount of profit, okay, which you're going to know before you get in the trade, just like you're going to know what the actual risk is before you get into that trade. If short, this is your level of maximum risk. So once again, if you sold it at 50, right? If you're selling now and you sell it at 50 and it hits top of that bracket, then it's basically going to get you out and you're going to lose $50. All right. So each week, Nadex will list 4 unique knockout contracts for each underlying market. So it could be in futures, Forex, could be in the 4 major U.S. stock indices. Whichever one you want to trade, that's up to you. What I'm going to be tracking, and I'm going to show you the ones I'm going to be tracking, but it's going to be the majority of them where we can provide you with some predicted price levels. All right. If the floor or ceiling is hit at any time during the week, the contract expires and a new one will create at a different level, providing continuous trading opportunities. So that's also nice. So let's say that for some reason, you have your 4 levels, and let's say it hits the upper level, right? So it exits out, right? So if you're long, it would have exited out. You get your maximum profit, and then a new level is created that goes even higher. All right. So there's always going to be 4 of them. So you have, and it's a pretty wide range, as you'll see here shortly. Okay, so let's look at some trading examples here. So when selecting a contract, you will see 2 numbers, one in red and one in blue. And just like with any contract, these are the bid price and the offer price to buy or sell the contract. The 2 prices will sit between the floor and the ceiling. If you buy, you believe the market will go upwards, right? And if you sell, you believe it will move downwards. So if I say I'm long, that also means that I am buying it. Or if I say I am short, that means I am selling it. Some people are not familiar with those terms. Bullish means the market wants to go up, and bearish means the market wants to go down. All right. So if I say I'm bearish, that means I want the market to go down, right? If I say I'm shorting it, that means I want the market to go down. All right. When you open the order ticket, you can choose your price and size, which will immediately show you the maximum risk and maximum profit potential for the trade. Once you have made your decision and placed a trade, there are 3 possible outcomes. So let's imagine you bought a knockout contract, meaning you think the market will move upwards, all right? Or we project the market's going to move upwards. So basically, these are the possible scenarios. If it moves upward, you start profiting right away. If it moves downward, you start losing right away. Just like if you're trading a future contract or a stock or anything like that, it's going to start moving right away depending on where you get in. So if you buy it at $1 and it goes to $2, you made $1, right? If you buy it at $2 and it goes down $1, you lost $1. You see what I'm saying? So the beauty of it is just like trading the actual instruments. So if it moves downward, you start losing right away. The amount will depend on how much the market moves. It will be somewhere in between your maximum possible profit and your loss. Like I said, remember, it's a pretty big window, and we're trading in that window. So we're not going for the maximum loss, and we're not going for the maximum profit, all right? It is predicting a level. It's predicting a price move or a number of certain points up or down. And that is what we were going to be going for. So it may say it's going to go up 75 points. That's what I'm going for. If it says it's 100 points, that's what I'm going for. Okay, it varies. The indicative price hits the ceiling. The indicative, once again, if you're not familiar with Nadex, that is their price. It's not always the same as the price that you're going to see on your chart. So, you know, if you have Thinkorswim like we do, you will see the indicative price is different from what you're going to see on Thinkorswim. It really doesn't matter, all right, what that indicative price is, because when we're buying and selling, all right, it's going to start making money or losing money from wherever that entry price is, just as if you were buying and selling an outright forex or a future contract. So, the indicative price hits the ceiling. The contract expires immediately. You receive the maximum payout as outlined before you place the trade. So once again, if for some reason you did carry it and you felt, okay, it's going, I take my profit X number of points, but let's say the market's running strong, you can hold it and just let it expire and take all of the profit. All right. The other thing you could do is the indicative price hits the floor, so the contract expires immediately. You take a loss as outlined before you place the trade. So you know what that loss is, all right? So instead of maybe being in something that you only run a risk, let's say you're only risking maybe $100, and for some reason something comes out, and all of a sudden the market just, you know, you're long and the market crashes, it goes down, right? So instead of, you know, losing, you know, $500, $600, $700 as you would if you're trading an outright forex contract, or you're trading a future contract or a stock, it's limited, all right? And so you're not going to get wiped out. You're going to know what that is before you get in. So you kind of have that buffer on your downside as well. Now, once again, remember, we're not trying to risk that maximum amount. Our risk is going to be somewhere, and our profit is going to be somewhere in this window here of the knockout, right? Because it's going to give us that floor and that ceiling. So we're going to be somewhere in between the floor and the ceiling when we make a trade. Okay, so here's an example. Here's a trading example to further illustrate the way knockout contracts work. So one of the ones we do follow is the US 500, okay, which is basically the E-mini or the S&P 500, as a lot of you that trade stocks or maybe even trade futures are familiar with. Let's say the contract's current indicative underlying price is 27.20, all right? And the floor is at 27.10 and the ceiling 27.60, right? So you have this window here between 27.10 and all the way up to 27.60. Let's say that we buy it at 27.20. So what is going to be our risk? It's going to be that 10 points, right? It's going to come down if it hits 20. If I buy it at 27.20 and it comes down to 27.10, that would be my maximum loss. So if it keeps going down, goes down to 26.80, 26.50, whatever, it doesn't matter. It's already limited my loss. But if I buy it at 27.20, hits 27.60, then I make that $40 of those 40 points. So the current indicative, once again, let's just go on. The current indicative underlying index buying price is once again 27.20, right? To find out the value of this contract, you subtract the floor from the ceiling, which in this case is 50 points, right? Or it's worth $500. So if you convert it over in terms of a dollar amount, you can see that this total window is $500. Once again, remember, we're trading in between that. I'm not shooting for $500. I'm not shooting even for $400. So we're trading little chunks out of the middle of it, okay? So what happens if you're going to buy this contract? So as with all Nadex products, your maximum loss cannot exceed what you put into the trade. To find out the maximum risk, the cost of entering the trade, you need to know the difference between the buying price and the floor. Now, once again, Nadex does this calculation for you automatically. You don't need to worry about doing it by hand, all right? So, and I'll show you that example here shortly, but that's something that Nadex will do automatically. In this instance, it's 27.20 or 27.10 equals 10. So in the case of the US 500, this equates to $10 per point. So your total risk amount needed to enter the trade is $100, right? Because you have 50 and 50 is 500, so 10 would be 100. So that would be your risk if you wanted to buy this particular instrument. And on this knockout that had a window 27.10 to 27.60, which is a total of 500 points, once again, depending on where you buy it, is going to increase or decrease your risk. The closer you buy to the floor, the less risk you have, right? The closer you buy to the ceiling, the more risk you have. And it works the other way if you're selling it as well, right? Okay, so the maximum profit potential and the difference between the buying price, 27.20, and the ceiling, 27.60, is 40 points or $400. A big advantage of knockouts, risk protection. I keep going over this because this is important. All right, and this is the advantage you have over just if you're a future trader or you like to trade Forex, or maybe you're a stock trader, which I prefer to trade the indices. This is what I love about these knockouts is risk protection. Whether bullish or bearish, the floor and ceiling structure works to protect you from exorbitant losses in the case of an unexpected event. And yes, there will be unexpected events that happen. Not very often, but they do happen. So why and how I trade knockouts? Why and how I trade knockouts. So why? First, knockouts allow me to trade a variety of financial instruments from stock indices, Forex pairs, and commodity contracts. And we'll also be tracking Bitcoin as well once that gets fully on board. Second, every position has a maximum ceiling and floor to protect against an unexpected big move, right? Or unexpected big loss. I don't care if it's a big move in my favor, but I don't want a big move against me. And third, the profit potential is just as large as if I was day trading stocks, Forex pairs, or future contracts without the high margins needed to trade them. I used to be a big S&P 500 trader back in the 80s when it was a huge contract. until the margins got to be like 25,000. Back then, you could trade it with a $5,000 account, and every point was $500, so it was a monster. But it can happen to where you get into a trade, and if it goes against you, something happens. I mean, you can get crushed. All right. So, but yet you can still make that kind of money here with these knockouts, but you're not going to get crushed if something major were to come out and move against your position. So how I make my trades? Using the Einstein Formula, I calculate the first level, which is the highest percentage win rate, as I mentioned earlier, and place my trade after an entry pattern is set up. If I'm buying or going long, right, on a position, I will exit at the first level, right, because that's my highest probability. Could I carry it for another level? If it's really, really strong, I may watch it a little bit, maybe go to that next level. But in most cases, I'm going to be getting out at that first level. I can manage my trades and my risk a lot easier that way if I get out at that first level. If for some reason there is an inversion, it's basically, when you look at the formula, there's basically what happens is sometimes the market will invert, the wave will invert, all right? And so then I have to reverse and go the other way, okay? So if for some reason there is inversion to the predicted move, I will calculate a stop and a reversal level on the selling short side. And I will provide that on the charts, and I'll show you an example of that here shortly. But that is, once I'm in a trade, I always have the fail-safe of reversing and going short if I need to do that. All right, and about 30% of the time, that is going to be the case, right? Or 25 to 30%, that is going to happen. But we have some really long streaks where you don't run into that scenario very often. Okay, you can. You never know when it's going to happen. But that's why it's so important. If you're going to trade it, you got to stay with it because it will eventually have a breakout. And typically an inversion, I've seen an inversion happen 2 times before the third one hits. So it is possible you could get inverted a couple times in a row before it hits. But like I said, it's not very often. But it will, and it does happen. So, once again, as I mentioned, inversions happen approximately 25% before hitting level 1. But, this is what I like, 75% of the moves do hit level 1, right, before they invert. Alright, so this is Nadex. Let's take a look at Nadex real quick here. Let me bring this up just a little bit here so you can see this. Okay, so basically, this is what you're going to be looking at when you go into your Nadex platform. You're going to have knockouts up here. You're going to click on that, and you're going to have all these indices here, right? You have your Wall Street 30, you have your US Tech, you have your Russell Small Cap, right? And you also have your US 500, which is ES, or the S&P 500, the E-mini. And so when you open it up, when I open up the US 500, see I have my 4 windows there, right? My 4 knockout levels. I have my floor and my ceiling. So if you look at the very first one, you have 44.68 to 45.18, right? So you can go anywhere from 44.68 up to 45.18. I can trade in between that without worrying about it hitting a ceiling and or hitting the floor. And there's different levels. This one is 44.58 to 45.08. So you see that? Usually what I'm going to be doing when I am putting on a trade. So let's say it predicts that it is going to go, right now it's at, when I took a snapshot of this was 44.82, right? Let's say I think it's going to go up to 45.15. All right. So I know I have room because this one won't even exit until it hits 45.18, which is fine. I mean, you know, if it goes up to 18, it's great. I'm on the long side, right? But I don't want to trade this one because this one will automatically get you out of 45.08, so it wouldn't allow you to carry it further because once it hits that 45.08, it's out of there. So if you buy it at 44.82, and I want to try to get out of 45.15, this one's going to get me out too early. So by and large, most every trade, if I'm buying it or selling it, if I'm buying, it's pretty easy. I'm buying on the upper one, on these windows up here, and I'm selling on the lower knockouts. Okay, so selling, I'm selling down here. I'm clicking on the red. If I say the market's going to go up, I'm buying it and I'm projecting it to go up. I'm going to be clicking on this upper one, this upper level, and I'm going to be clicking on the blue. All right. And that's also, I'm also looking at to make sure that I'm covered on the downside. So if my reversal is somewhere below, let's say for some reason my reversal, I would reverse at 44.60. Well, you could see here it'd get me out too early. It'd get me out at 44.68. So I may come down here and take this one and do the 44.58 because then that would give me some room, you see, for my stop. And in most cases, I'm going to be fine going with the first one or the second one. But that's something you kind of want to glance at as you want to make sure that whatever the profit objective is and whatever that inversion or reversal point is somewhere in between these two numbers. All right. And it will come. I know it can be fast. I highly suggest if you're trading these knockouts, find something you like. It could be the US 500. It could be the Russell. Whatever it is, don't try to trade them all. I mean, because there's really no advantages to that. You can do very well just trading one of them. All right. So anyway, okay. So you can see here is when. Let's take a look at the maximum loss and maximum profit. So if you see here what I did is I clicked on this little red button here, right? And as you can see here on the red button, it shows you what your maximum loss is and what your maximum profit is. So since it's a red button, that means I want it to go down, right? So if I want it to go down and it hits the upper level of this channel, right, of this knockout, which is 44.88, and I sold it at 44.82, my maximum loss is $90. But that gives me $435 of room on the downside, all right, to get in and get out, all right? So that's what it means by giving you a maximum loss and a maximum profit. So the thing is when you click on it, you can look to see if you can tolerate that maximum loss. If that were to happen, remember, this is catastrophic. This is assuming it goes against you, right? So you can look at this and say, well, $90 is way too much for me. Okay, so wait for it to come up a little bit more, right, in price, and then go ahead and take your short. So maybe you wait for it to come up to 83, 84, then go ahead and take your short, all right? And that will lower, right? That's going to lower your loss, but it's also going to increase your maximum profit potential to the downside. So hopefully that's clear. So it's nice you don't have to do the calculation. They provide it right there for you. And of course, it'd be the opposite. If you clicked on the blue or on the buy, you'd see the same thing. You're going to see a maximum loss and a maximum profit. All right, so that's really cool. Now, as far as what is required, what Nadex requires is, let's say you wanted to sell this, all right, and it's $90. You're going to have at least, $90 or more. So because their assumption is you take the maximum loss, right? So they want to make sure you have at least $90 in your account to cover that maximum loss. If you're trading two of them, it's going to be $180. So you have to have at least $180 in your account to cover the loss if that were to happen. In most cases, you're not going to be taking that kind of, you're going to be getting out before that. But that doesn't matter. That's what they're looking at. So it depends on how big of account you need, depends on how many contracts you plan on taking, and then whatever this maximum loss number is, that's what you have to have in your account before you put on the trade. And it's not going to allow you to put it on. If you don't have enough money in your account, you want to trade two or three of them, it's not going to allow you to put it on if you don't have enough money in there. It'll reject the order, all right? So then you may have to go down to two or go down to one, depending on, your risk tolerance and how much money you have in your account. So this is what you're going to be seeing in the morning. These are the charts. So basically, like here in the crude oil, at this time we were looking for crude oil to go up. So the way it works is that I will have a projected high. All right. So I will say that my profit target is 90.15. Okay, that's my first price level. So where do I buy it down here someplace? I want to get out if it hits 90.15. And if for some reason it doesn't hit 90.15 and I need to reverse my position, I'm going to reverse it at 89.15. So I'm typically buying somewhere in the middle, and I am going to reverse, go short at 89.15 if my profit target isn't hit first. Like I said, this is first level, all right? After it hits a level, okay, it may go several more levels up. I don't care. I'm playing the highest probability level, which is going to be 90.15, all right? That's the other thing you want to make sure that you can tolerate. If for some reason you need to reverse, if you want to play it that way, and there are other ways to play this besides stop and reverse, then you have to make sure you have a larger account in order to do so, all right? Smaller accounts are not going to be able to do that, all right? So, we'll talk about that here in a short. There's really a couple ways you can do this. Really, it's a lot of different ways you can do this, but this is two of the most basic ones, all right? So, this is suggested ways to trade the breakouts. Now, here are the knockouts I'm going to follow and post. I'm going to post the entry. I'm going to post the profit target, which is that level 1, right? And stop loss reversals, which is basically the inversion point. And you're going to see it on the chart. So I'm going to say I'm buying here, okay? I'm getting a buy signal. This is going to be profit target. And this is where my reversal and point is that I would go short. So if I'm long and it for some reason doesn't hit my my level 1 before it reverses and then inverts and goes down, okay, but remember, it can happen, somewhere in that 25 to 30% of the time, then you'll see that posted as I showed on the charts prior. All right, so you'll see that. So I'll be looking at the E-mini. I'll be looking at the E-mini Russell and E-mini S&P. I'll be looking at the E-mini NASDAQ. We'll be looking at the mini Dow Jones. I'll be watching gold, silver, crude, watching natural gas, and eventually Bitcoin once that gets on board. All right. So let's say somebody's out there and doesn't want to trade knockouts. Well, you could still use this information if you want to trade the outright futures, or maybe you're a Bitcoin trader and you like to scalp Bitcoin, or you like to trade gold and silver future contracts, you can do that. Or maybe you're a stock trader. Instead of trading individual stocks, trade the indices. You can do that as well, right? But I like the knockouts because of those built-in fail-safe levels, and that's what I like. I like that protection in case of something catastrophic. If you've been trading as long as I have, I promise you, you will be in a trade someday, and there will be a catastrophic event against you. All right? That's just the way it is. It happens to everybody, and if you think you're immune to it, you're not. If you think you can get out fast enough, a lot of times you cannot. You can get locked in, well, you can't get out, because if the market's going down and there's no buyers, you're not getting out. That's what I like about knockouts. It will protect me. So basically, there's two types of ways to trade these. Remember, this is a more aggressive approach. If you're familiar with my core package, remember the core package has patterns. It's a lot more conservative approach. It's not as quick. All right. Now, if you've advanced to CB, then you know how to scalp. But most of our scalping is going to be done on the forex pairs, right? In this way, we can go ahead and we can scalp on all these other different instruments, and it is going to be quick. But it's also, anytime you're doing that, obviously you're going to be taking on more risk. But the profit potential is so high, it's up to you whether you decide you want to do that or not. But the amount of money that can be made on these things is just absolutely phenomenal. But once again, this is not something you want to start off doing. You want to be, you want to be familiar with trading. Do not even think about trading these lives until you've done it in a demo account, which Nadex will set you up. They'll give you some play money, and you need to practice, and you need to see how well you do with these knockouts. You need to go back and you need to look at what kind of losses you're taking. You need to go back and see what kind of risk you're taking. And then you can say, okay, based on what I'm seeing here in my past trading, will I be able to have an account size large enough? Number one, and will I be able to handle, those types of losses, all right? The profits are easy to handle. Can you handle the losses? You are going to have losses, folks. It's reality. So we all think about profits, but very seldom. Nobody wants to ever think about the loss. That's the number one thing you need to think about first, is the loss. Can you handle the loss? If you can handle loss, the profits will take care of themselves. All right. So the less aggressive approach is only take longs, which means you're buying, or only take shorts or selling. So buying, you want it to go up, right? Selling, you want it to go down positions. So for the instrument you're trading, if you take a loss, double your position size until the profit target's hit. So let's say that you're long, and for some reason you're a buyer. You decide you want to be a buyer that day. Or you want to be a seller, and maybe you think that the market's been going up, you want to be just a buyer, or you want to be a seller, and you think the market's going down, which is not necessarily the best way to trade it, because some of your bigger days are opposite to the trends, what they call the trend, right? So, but you can come in just being a buyer or being a seller. So if you're long and it reverses before it hits your target, then you get out of your trade and you wait for the next long entry to come along, which I will provide. So just taking buys or just taking sells, that is a less aggressive way of trading it. So like I said, the market can have several inversions before it starts moving. You will avoid some of those inversions by taking just longs or taking shorts. All right. And of course, the more aggressive, and this is going to require bigger counts, obviously, is take both long and shorts for the instruments you're trading. So after a losing trade, you're going to double position size until profit targets are hit. In most cases, my target and my profit are going to have the same amount of points. So if I'm looking to make 50 points, all right, depending where I get in, I could be risking 100 points to get out. And that's something you need to keep in mind. So if you double on that next trade and you win, you're basically going to be breaking even. All right. So you have to be able to manage that risk. So a lot of times what's going to happen when an entry point is hit, it is going to have a pullback. So you're taking on less risk, but you're also increasing more of your profit, as I mentioned earlier. So if you jump in right away, you can do that and go for that level one, or you can wait to see if you can get a pullback and take on less risk, and also have the potential to make more money on the trades. A lot of the trades that I've been making, it does have a tendency to pull back, and so I'm able to actually get in at a better level. So I'm really limiting that risk to the downside, but I'm also increasing my profit potential once it hits my target price. All right. So that's it. I wanted to clarify everything. I hope it makes sense. The most important thing is to make sure that you're logging in every morning. The morning show is getting ready to start. Once again, I'm just waiting on my programmer to finish everything up. It's going to be in the morning. The plan is it's going to be from 9 a.m. Eastern to probably for the first hour. That will be open to the public, subscribers and non-subscribers. After that, we shut it down to the public, and then it's just going to be for my subscribers. All right. So at least if you're not a member, you can at least get an idea if these knockouts. And I'll be calling out some patterns as well. It's going to be something you'd be interested in joining us. You can do that. And then, of course, for the students that are actively purchased the packages and in the live room, then once we switch off from the public access to the private access, then we'll just continue on with not only calling out the core trades and the setups there, but also doing these knockouts. All right, so that's it. If you have any questions, you know where to find me, binaryprostrategies.com. I hope this short little video was beneficial, if it makes sense. And if not, just ask me a question. You know, I'll be glad to always answer your questions for you. All right, y'all take care, and hopefully we'll see you live in the chat room. Take care.